A very good morning, students. Our session of Financial Management 1. Now, as far as our previous session was concerned, in that we have seen about the different new financial instruments through which an investor is going to trade in money market plus in capital market. So, in the last session, we have discussed about securitization of debt. Now today there is a discussion of secured premium notes. Secured premium notes are nothing but a share warrant which are only issued by the listed company after getting the approval from the central government. So it is a warrant which is easily negotiable by the investors, and only listed companies have a right to issue secured premium notes, and the prior approval from the central government is required at the time of issuing this kind of secured premium notes. To meet its long-term and short-term needs of finance, a company may issue various kinds of security to raise funds from public. So again, with the help of secured premium notes, a company is able to satisfy their long-term and short-term financial needs in their organization. A company may decide to issue securities because it needs startup capital or to repay debts or even to expand. So there are many purposes for issuing securities by the organization. It may also need an infusion of new management ideas and know-how. So again, the finance is required to implement any new managerial ideas or to implement any technical know-how. These can be had by a wider ownership base. Generally, it is not possible for the new organization, that is to issue this kind of secured premium notes. The company who is there in the market for the number of years, and when the financial requirement of the organization is really very strong and the listing in any recognized stock exchange is required, so at that point of time those organization is able to get direct finance from the general public by issuing this kind of secured premium notes. When the investor buys securities, commonly referred to as share, he is enabling the company to carry on its business using the funds provided with little stress. Yes, as far as the other securities are concerned, the securities of other means if we are talking about the shares, if we are talking about the debentures, then it will be quite little stressful to issue that common form of securities. But as far as the secured premium notes are concerned, it is really very convenient for the organization to issue the secured premium notes. So it's all about the secured premium notes. Then after, the next one is non-convertible debentures with ditchable warrants. The name itself suggests the debentures which are not converted into equities, and the debentures which have the ditchable warrants with them. So these debentures are easily negotiable in the market by the investors. They can easily purchase or easily sell their debentures in capital market with the feature of non-convertible of the debentures. So let's see about how these non-convertible debentures are working. The holder is given detachable warrants with a coupon rate and give the option to buy a specific numbers of share. Here the option is given to the debenture holders for the purchase of a specific number of shares or having a coupon rate on their warrants. The holder of non-convertible debenture with detachable warrants get option to purchase shares in specific number from the company. Price for the shares are predetermined. Already the price knowledge is there in the mind of investors. Non-convertible debentures are issued for the period of 5 years. The maximum maturity period is 5 years. If the holder of the warrants do not apply and surrender the warrants to the company on maturity, he will get principal amount with interest. If the debenture holder do not choose the option to purchase or to convert its debenture into equity shares, then definitely at the time of maturity he will get the total principal amount with the interest rate on it. So it is really one of the convenient form of securities. Then after, zero coupon bonds. The name itself suggests that the interest rate on these bonds are zero. Means these bonds are issued at discount and redeemed at the face value. So whatever the difference between the discount rate and the face value, that will be the benefits to our investors. Suppose the bond value of any debenture is 80 rupees and the face value is 100 rupees. So when the investor purchases a specific bond at 80 rupees, so he is just paying the discount rate, and at the time of maturity he will get 100 rupees of his bond. So total income generated by investor is 20 rupees. Means the difference between discount and the difference between the face value. Let's have the discussion on it. A zero coupon bond is a debt security that does not pay interest but instead trade at a deep discount, rendering a profit at maturity when the bond is redeemed for its full face value. Generally here the discount is given, but the rate of discount is really very high. So for that reason, that discount is known as deep discount. Some bonds are issued as zero coupon instruments from the start, while other bonds transform into zero coupon instruments after a financial institution strips them of their coupons and repackage them as a zero coupon bonds. Because They offer the entire payment at maturity. Zero coupon bonds tends to fluctuate in price, much more so than coupon bonds. So generally the price range of zero coupon bonds is really very high as compared to the normal debentures, as compared to the normal bonds. These kind of instruments is not famous in our Indian market. Make my words. These are really very famous where the economy is already developed, when the investors have nitty-gritty knowledge about the market, that how the company will respond, how the government will respond. So these kinds of financial instruments are for the developed country, not for the developing countries. A zero coupon bond is a debt security instrument that does not pay interest. As we already discussed, zero coupon bond trade at deep discount, offering full face value profit at maturity. The difference between the purchase price of a zero coupon bond and the par value indicate the investor's return or investor's profit. The next one is zero interest fully convertible debentures. The name itself suggests the interest on debenture is zero, means these debentures are issued at discount and redeemed at face value. But the main feature of these debentures are they are converted into equities at the time of maturity. So if the market is not sound but the company want to raise their capital through equity share only, and if right now if the company company issue equity, then definitely investor will not respond in it. So in this particular situation, the company choose option to raise their capital through debentures, and at the maturity period the whole debentures will be converted into equities. So these options are for those organizations who wishes to raise their capital through equity, but right now the market is not responding to them. A zero coupon convertible is a fixed income instrument that combines the features of a zero coupon bond with that of a convertible bond. Due to the zero coupon feature, the bond pays no interest and if thereof issued at a discount to par value, while the convertible feature means that the bond holder have the option to convert bonds into a common stock, that is into equities of the issuer at a certain conversion price. So at that time the whole debentures are converted into the current market price of the equities. Zero coupon convertible marry two features: zero coupons and convertible. A zero coupon security is a debt instrument which does not make interest payment, as we already know that, and investor purchases these security at a discount and receives the face value of the bond on maturity date. Because there are no payments prior to maturity, zero coupons have no reinvestment risk. Yes, the perception of risk is really very low, because before the maturity, means prior to maturity, the debenture holder is not able to sell their debenture in the market. So the perception of risk is really very low. A convertible security is a debt instrument that can be converted into equity of the issuing company at a given time period. So again, when there is a conversion of debenture into equity, so at that point of time, it take a time for the conversion of debenture into equity. But when the time is over, at that time they gets the maximum benefit of trade in equity. So I think it is clear to everyone. Let's move further. It's about deep discount bonds. Deep discount bond and zero coupon bonds both are same in the nature because they offer at a very discounted price and then after it will mature at the face value. Deep discount bonds are issued at a deep discount on its face value and slowly and gradually it will redeem at a par value. Again, this kind of bonds do not carry any kind of interest on them. They issued at discount and matured at a face value. A deep discount bond is a bond that sells at a significant lesser value than its par value. In particular, these bonds sell at a discount of 20% or more to par and has a yield that is significantly higher than the prevailing rates of fixed income securities with similar profile. Yes, the rate of discount is 20% or more in it. There is one example that in 1992, that is IDBI, Industrial Development Bank of India, they issued the deep discount bond. The face value of the bond is 1 lakh rupees, but at present it was sold at 2,700 only. So investor is supposed to pay 2,700 and at the time of maturity, that after 25 years they will get 1 lakh rupees of their investment of 2,700. So this is the best example of deep discount bonds. Okay, I think it is clear to everyone. Deep discount means when the discount rate is really very high and make sure the maturity period is also very long. Means not within 5 to 6 years you are getting your total amount, but it will take a time to recover the whole amount by the organization. So when the company offers the deep discount bond right now, so at the time of maturity, the maturity period will be 20 years, 25 years or 30 years depending upon the financial planning or financial capacity of that particular company. Now, the next one is double option bonds. The name itself suggests when the two options are available on any bond, so that will be known as double option bonds. A doubling option is a provision in a sinking fund that gives a bond issuer that right to redeem twice the amount of debt when repurchasing callable bonds. A doubling option allows the issuer to retrieve additional bonds at the sinking fund call price, or a doubling option is a provision included in some bonds indulge or legal agreement. It is related to the bonds sinking fund provisions. In short, we can say that the total investment is divided into two parts. The first part that shows the face value of that particular bond. Suppose the face value of the bond is 10,000. Then when the double option bond is there, so first and foremostly company will show your face value of bond, that is 10,000, and the second option, in second option the company will show the interest rate, that how much you are earning on your 10,000. So there is no basic difference between this double option. The whole bonds are divided into two parts, so that the investor comes to know about what is the principal amount and what is the interest amount. So that's all about double option bonds. Then after, stock invest. It is really very interesting, and it is a new facility available to investor at the time of making investment in capital market or in money market. Again, it is a kind of stock, but this stock is issued by the government with the help of SEBI. Yes, here there is means the company is not able to issue stock invest, but only government, that is only central government or any state government has a right to issue stock invest, but the prior permission of SEBI is required. When the investor submits an application for the new issues to be launched, then he can make use of stock invest. Yes, when the applications are concerned, so when the submissions of investors' applications are there, at that time the first priority is given to for the purchase of stock invest, and make sure it is a stock of central government, so the chances of failure, the chances of risk attached with this investment is really very low, and there is 100% guarantee as far as the return is concerned. It is such a tool which is mixed form of authority letter, check guarantee and cash. The investor has to make an application to the bank for stock invest. So through bank, an investor is able to purchase the stock invest of any government security option. So one or investor is able to make an investment in any recognized organization with the help of government by investing in stock invest. So here investor make an investment in a prior basis, and when there is any IPO of the new organization or the stock or any strong company, then directly there is an investment of any individual with the help of stock invest. Now the next one is euro issues. Euro issues means it is a source of finance or a capital obtained to raise money external to home country in foreign currency. So here the company has option to raise their funds in the foreign market, but to enter in a foreign market to expand their fund, a prior permission of government is required. Here there are 4 different bonds through which company can raise their external financial fund in foreign market. The first one is foreign currency bond. So these bonds are subscribed by NRI in foreign currency. These bonds are in a foreign market. So when the foreign market is concerned, and definitely when you are going to approach the foreign market, when you are going to approach the global market, at that time the bonds value is going to be count on the foreign currency, that is the bonds is available in dollars. Then after, European depository receipt. Yes, there are few depository receipts like American depository receipts, European depository receipts and global depository receipts. So when we are focusing on European depository receipts, these European depository receipts are available in European countries, or it is only limited to European markets out of the India. So here the target audience is limited up to the European countries only. And the last one is global depository receipts. Here there is no restriction on the basis of any country or on the basis of any selected target audience. But global depository receipts means here the organization is going to serve their financial instruments to everyone. So it is available in a globe. So one can invest or one can offer their securities in each and every countries of the globe. So global depository receipts has the wider approach as compared to other securities. And the features of these all bonds and receipts are one is to same. So there is nothing new as far as the receipts are concerned. And now the last part of our unit is derivatives. Yes, derivative is one of the well-known instrument of our capital market. When an investor want to raise their fund in a capital market, or when an investor want to maximize their earning with the help of investment in different securities of the different companies in a capital market, then the derivative is there to enhance their investment return. Derivative is a kind of asset, and on the basis of this asset, an investor is able to trade on a local basis, on the national basis, or on the foreign basis. So, through these securities, through this derivative, investor is able to hedge their risk. Here, with the help of derivatives, investor comes to know about the different types of managerial risk or management risk which is attached with the particular investment. And these risks were prevented in the past in insurance or pension fund for prevention of risk, and now it has become prevented in the capital market. Just like in insurance and in pension fund, when the risk is total covered by the insurance company or by the pension funds, the same way through derivatives the total risk is going to be covered in the capital market. Derivative provides a protection to investors against the fluctuation in the prices of shares. Derivative has an ability to control the prices of shares. When there is high fluctuation in the prices of shares, but through derivatives they are able to control the prices, and when the prices are to be controlled, then definitely the protection of investors' risk is going to be controlled. There is maximum flexibility available in the credit side of the investors. So, let's discuss in our slide. A derivative is a financial security with a value that is reliant upon or derived from an underlying assets or group of assets, a benchmark. The derivative itself is a contract between two or more parties, and the derivative derives its price from fluctuations in the underlying assets. So there is a contract between an investor and the other party that the third one is going to control the risk of investment in the particular securities in which the prices are fluctuating. The most common underlying assets for derivatives are stocks, bonds, commodities, currencies, interest rate, and the market indexes. So one can definitely hedge their risk with the help of derivatives. These assets are normally purchased through the brokerage. The derivatives can trade over the counter or on an exchange. Over the counter derivatives constitute a greater proportion of derivative markets. OTC traded derivatives generally have a greater possibilities of counterparty risk. Counterparty risk is the danger that one of the parties involved in the transaction might default. These parties trade between two private parties and unregulated. Conversely, derivatives that are exchange traded are standardized and more heavily regulated. In short, આપણે એક્સપ્લેનેશનના બેઝિસ ઉપર એટલું સમરાઇઝ કરી શકીએ કે ડેરિવેટિવથી જે કેપિટલ માર્કેટની જે સિક્યુરિટીઝ છે કે જેના પ્રાઇઝીસ મેક્સિમમ ફ્લક્ચ્યુએટ થાય છે, તો કોઈ પણ ઇન્વેસ્ટર જો ડેરિવેટિવના ઓપ્શનમાં પોતાના ઇન્વેસ્ટમેન્ટને સિલેક્ટ કરે છે તો ડેફિનેટલી જે કાઉન્ટર પાર્ટીનું રિસ્ક છે એ ડિરેક્ટલી રિડ્યુસ થઈ જશે. સપોઝ કોઈ શેરના પ્રાઇઝીસ આજે 100 રૂપીસ છે, કાલે 120 થાય છે, લેટર ઓન ધ નેક્સ્ટ ડે ઇટ વિલ બીકમ 92, ધ નેક્સ્ટ ડે ઇટ વિલ બીકમ 112. સો કોઈ કોમન ટ્રેન્ડ તમને શેર્સના પ્રાઇઝીસમાં જોવા નથી મળતો અને તમારું ઇન્વેસ્ટમેન્ટ એ શેર્સમાં મેક્સિમમ છે. તો ડેફિનેટલી એઝ એન ઇન્વેસ્ટર યુ આર સપોઝ ટુ કંટ્રોલ યોર રિસ્ક, એટલે તમે તમારા રિસ્કને હેજ કરો છો. તો આ હેજિંગ વખતે તમે ડેરિવેટિવનું ઓપ્શન સિલેક્ટ કરશો. જ્યારે ડેરિવેટિવનું ઓપ્શન સિલેક્ટ કરવામાં આવે છે એટ ધેટ પર્ટિક્યુલર પોઈન્ટ ઓફ ટાઈમ તમે તમારી પ્રાઇસ રેન્જ છે એ તમારી થર્ડ પાર્ટીને તમે કહી દો છો કે આઈ એમ ગોઈંગ ટુ પરચેઝ ઓર ધ સિક્યુરિટી બિટવીન 115 to 123. આ તમારી પ્રાઇસ રેન્જ છે. એટલે હવે જે થર્ડ પર્સન હશે એ ગમે તે પ્રાઇઝીસમાં ચેન્જ થાય, સ્ટોકના પ્રાઇઝીસ 75 થઈ જાય, 50 થઈ જાય, 60 થઈ જાય, પણ થર્ડ પાર્ટીએ તમને જે પ્રોમિસ આપેલું છે દેટ દે આર ગોઈંગ ટુ પરચેઝ ધ સેમ વિથ 115 to 123. તો અહીંયા તમને એટલા જ પ્રાઇઝીસ મળશે તમારા સ્ટોકના, બિકોઝ તમે ઓલરેડી તમારા રિસ્કને હેજ કરેલું છે. સો ધીસ ઇઝ વન ઓફ ધ બેસ્ટ ફીચર ઓફ ડેરિવેટિવ્સ. બટ અગેન somehow there is a risk attached with this securities also. જો સ્ટોકના પ્રાઇઝીસ હાઈ થઈ જશે, સપોઝ સ્ટોકના પ્રાઇઝીસ થઈ જાય છે 180, તો પણ તમને ત્યારે બેનિફિટ્સ નહીં મળે. તમને સ્ટોક 115 to 123માં જ એના પ્રાઇઝીસ મળશે. એટલે બેનિફિટ પણ છે અને સાથે ડેરિવેટિવ્સમાં રિસ્ક પણ એટલું બધું અટેચ્ડ છે જ. હવે જો તમારી પાસે બુક્સ હશે તો એના પેજ નંબર 130માં તમને આપેલું છે ડેરિવેટિવ્સના ડિફરન્ટ ઓપ્શન્સ, એની ડિફરન્ટ કેટેગરીઝ. સ્વેપ ઇઝ ધેર, ઓપ્શન ઇઝ ધેર, ફોરવર્ડ ઇઝ ધેર એન્ડ ફ્યુચર ઇઝ ધેર. તો આ એક પોઈન્ટ છે એ અત્યારે હું રાખું છું નેક્સ્ટ સેશનમાં ગમે ત્યારે આ પોઈન્ટ આપણે ક્લિયર કરશું એટલે આપણો સિલેબસ અહીંયા કમ્પ્લીટ થઈ જશે. સો થેન્ક યુ ગર્લ્સ, થેન્ક યુ સો મચ.